We've just updated our forecasts for Australia and other key economies. Israel's strike on Iran does add a whole new dimension of geopolitical risk to the outlook. At the same time, risks from the tariff war have been de-escalating. Some deals have been done, however vague, and it's looking increasingly likely that where the US tariffs will land is going to be much lower than where they were first announced, and that countries other than China won't be retaliating with tariffs of their own. Now, initial market reactions to these kinds of events can sometimes be overdone. Central banks are going to want to take a wait-and-see approach before responding. It does make decisions about what to do with interest rates more complicated, but globally interest rates are still headed down. Now, most major central banks are already some way through their rate-cutting phase, and in some of them, the debate has turned to whether they've done enough. So while we do still expect the Federal Reserve, the European Central Bank and the Bank of England to cut rates further from here, they're not going to be rushing things. This is especially the case for the Federal Reserve. While US tariffs are going to be lower than initially announced, there is still a boost to domestic inflation from those tariffs, and the Federal Reserve will have to weigh the balance between higher inflation and slower growth. In Australia, interest rates are also headed down. The Reserve Bank Board cut the cash rate by 1/4 percentage point in May, as we expected, and it signalled that further cuts would happen as long as inflation was sustained within its 2 to 3% inflation target range. But it also emphasised that it wanted to take a cautious and predictable approach to further reductions in interest rates. That means they're not going to rush things either. That's why we don't expect that the Reserve Bank will cut rates at its July meeting, but we are still expecting 2 further rate cuts this year in August and November. We have also reassessed the outlook for 2026, and we now expect 2 more rate cuts early next year. We think the most likely timing is February and May, and both of those are also likely to be rate cuts of 1/4 percentage point. If that's right, it means that by this time next year, the RBA cash rate will stand at 2.85%. We would regard that as at the lower end of the neutral range for the cash rate. There are a number of reasons why we've reassessed the policy outlook for next year. Most of them boil down to a lower inflation outlook. At the moment, the Reserve Bank has an inflation forecast that's completely flat at 2.6% for trimmed mean inflation. That's their way of signalling that they're not in a hurry to cut rates further, but they're willing to if they get a better result on inflation. When we came to reassess the inflation outlook for late this year and early next year, we're seeing lower housing-related inflation because population growth has slowed, and we're seeing lower imported inflation because of the slower global growth and the reduced tariff turmoil in the world. That all means that we think that underlying inflation, as measured by the trimmed mean, is going to go below the 2.5% midpoint of the 2 to 3% target range. Once these shifts are clear in the data, the Reserve Bank Board will have scope to reduce the restrictiveness of monetary policy. But until that becomes clear in the data, the Board is going to want to take that gradual path.
The content of this recording is informational and of general nature only, and is not intended to constitute a research report or reflect any recommendation or financial advice. It has been prepared without taking into account your objectives, financial situation, or needs, and investment decisions should not be based on it. You should obtain your own independent advice before proceeding with any investment decision. Whilst every effort has been taken to ensure that the contents are correct and any opinions, forecasts, conclusions are reasonably held, based on information at the date of recording, Westpac does not make any representation or warranty as to the accuracy or completeness of the statements or information contained in this recording, and any liability therefore is expressly disclaimed to the extent permitted by law. None of the material included in this recording should be copied, published or reproduced in whole or in part without the prior written permission of Westpac.